Do I extrapolate from that you think there is still, a bit of runway when it comes to being risk on, maybe a little bit more overweight on tech and some of the same themes that we saw drive the rally of the first half in the second half?
Yeah, I think there's runway left, and I think technology is still the place to be. Growth stocks are still the place to be. Certainly did well in the first half of the year. Today it's going to give everybody some pause to see a day like today with yields spiking the way they did. But if we look at the second half of the year, we still look at a constructive environment for stocks, and especially growth stocks and technology, the Magnificent Seven, as we call them. We wouldn't be trimming those yet. We would stay with those because they're more immune to, take today, Microsoft and Apple were both positive.
So valuations at this point in that space are okay for you still?
The valuations are sky high for stocks like NVIDIA. But when we look at how we trade stocks and what we trade based on, there's concern that there would be an earnings crash, and the earnings for these companies continue to come through. Could we see a correction or a more significant correction, especially in some of these high flyers? We certainly could. But, looking at a long-term secular growth story that many of these stocks have, there's been comparisons to the dot-com era, but it's very different. These are established companies that are going to benefit from this AI technological revolution. And we're also seeing the leadership starting to broaden out. We saw small caps do a little better in June, and we're seeing an overall broadening of the breadth of the market.
And David, what will you be watching out for as banks kick off earnings season next week?
What we expect that, it's certainly with the stress test, they were able to do some things with dividends, and that was a positive for banks. We're still concerned about the financial services sector simply because we don't know that we're out of the woods there. The Fed has created a problem for the banks. That's what happened with SVB and a handful of others, and that risk is still there. So I think the earnings for some of the powerhouses like JP Morgan that will continue to do quite well, but the regional banks, we would continue to avoid those for now. There's been some periods where they've spiked off the lows, but there's still a risk because the Fed has created a problem with these high rates that they can't bring their money market rates up to without just suffering losses.